depending on the Q&A, we'll just see how long it takes.
Look, you don't have to rush on purpose. I mean, we like detail too.
Yeah, no, yeah. They just really are fairly easy concepts when someone actually explains it to you, right? I can come in and say, oh, it's a 40-year interest only, and you're like, I have no idea what that means. Or, yeah, let's do a 2-1 buy down. It's awesome. It'll save your people money, and yada yada. But once I actually go through them, they are pretty easy to understand.
Awesome. Well, actually, since we got everybody kind of paying attention to you now, anyway, let's just get started. Let me show you, introduce you to the room. We got agents in the house. Oh, I don't even, because it's mirrored.
Hi, everybody.
Hello.
Hi. Oh my gosh. Hi. Oh my gosh. Metro title. Oh my gosh. What are you guys doing?
Yeah, surprise. They came to see you in person. No hugs. Hey guys, thanks for being on. We're going to get started. Trevor's in Washington. I didn't realize till last night he wasn't going to be in person, but I didn't tell him.
Yeah, this was a very, very last minute thing for me. So yeah, sorry about that, guys. I do like being in person, so sorry about that.
So I'm going to turn it over to Trevor. He's going to share his screen share and introduce him a little bit more. But we were chatting right before, as you guys were kind of getting settled in, and it's so weird how when you schedule a training almost 2 months in advance in a changing market, the things you were going to talk about kind of changed a little bit. So I'm assuming Trevor's going to change some stuff on the fly from a presentation that used to work a couple of months ago. The market's different. The lending industry is different.
Yeah.
We got a good opportunity here, I think, because of that. I'm glad that it's changing because it was easy, but it was also a shit show. Right, when the market was the way it was, and the poor buyers could, it was just so frustrating. They're just like, I can't deal with this anymore. 12 more offers, and I haven't got anything. So I'm excited for that shift of it to where it's a little bit more normalcy on presentation, negotiating. Some of the things that were really important tools are coming back instead of just well, how much you got? Throw it all at it, Okay, so Trevor, we tried out the screen share, so go ahead and share your screen, and I'm just going to sit down and let you kind of take over. And we are recording this. After Trevor's done, that'll be around noon. We've got a lunch sponsor coming in here that's going to bring you all lunch, and so we'll break for that. And then I'm going to leave Zoom on because we've got somebody jumping on in Washington that wants to hear about our brokerage model and stuff, and then we're going to talk to a couple of you too. And you've got Scotty and so after this is all over, after that short little break, we'll kind of if you're staying for that, stay in here. If you're not and you want to go out there and visit or whatever, then we can break and you can do that. We'll just shut the doors, and then we're going to talk in here, and I'll just leave this on for the ones on Zoom. Okay, Tyler, good to see you. Okay, Trevor, it's all yours.
Okay, well, let me just tell you a little bit about myself. My name's Trever Sears. I've been in the industry for about 10 years now, so almost a decade of experience. I have worked at every type of lending institution that you can work at. So I do know how all of them work. I understand the margins that they work off of. And I've actually decided to become a broker. So I work at a brokerage. That's just a different type of lender. We have a lot more options available to us, and our margins are a lot lower. So with our company, you're going to see lower rates, lower fees, and I have the ability to close a lot faster and also, I guess, submit different deals to different lenders depending on the situation with your borrower. That's something that I've become really, really good at. I've saved a ton of deals for a ton of different realtors because of that. Yeah, anyway, okay, so we'll start moving on. And I did want to echo what Jeff was saying. The market right now is crazy, but it's really, really awesome as well. I've seen a ton of realtors and a ton of lenders drop out of the market because it's a little bit hard. They were so used to it being easy and everything was just given to them. And now that they have to work, a lot of them are dropping out. So if you're one of the people that's willing to get on the phone and willing to put in the time and willing to do a little bit of legwork, I think you'll see that your business will start to go up. And especially after rates go down in about a year, you already being the person that's in the market, who stayed in the market, who weathered the storm, is going to be super helpful as well. So Yeah, just keep it up. Don't get too discouraged and keep moving forward. All right, so let's hop into this presentation. We're going to look at two separate loan products. One is a 40-year interest-only product, and the reason that that one works out really well, the borrower will actually be, they'll actually have a lower debt-to-income ratio because the payment is going to be lower. Their amortization's over 40 years, so they get a lower payment, even if the interest rate is higher. And typically on a 40-year interest only, the interest rate will be higher, but their payment will still be lower because of the 40-year amortization schedule. Let's hop into that really quick.
Trevor, have you shared your screen? Because we don't see it.
No, I'm about to right now. I just wanted to give everybody an overview of what was going on, and then I was going to do that in just a second. Okay. And then the second one is a 2-1 buy down, and that is something that a lot of builders use, and they use it for marketing purposes. It shows the buyer of their property that they're going to get a much lower interest rate for the first 2 years, and even a low interest rate in the third year, and then on the fourth year, on the third year, they're going to get a normal interest rate. So it gives them the opportunity for 2 years to wait for interest rates to go down and do a refinance. But we'll go over this stuff right now. Okay, so can you guys see my screen?
Yep.
Okay. All right, so let's start with the 40-year interest only. The 40-year interest only, you can use it on refinance, you can use it on purchase, and we can use it on multiple different products. The interest rate starts at 680, and they'll go up to an 80% loan to value. And the 40-year interest only is a 10-year interest only for the first 10 years, and then it goes to a 30-year amortization. The other really nice thing about this is the loan recaps every time they make a principal payment. So if your buyer wanted to put a little bit of money down on the principal, their monthly payment would actually go down as well, because the amount of interest they need to pay would go down based off of that. The loan amounts we can go from are $75,000 all the way up to $3 million. And this is a loan product that's considered a non-QM loan product. So this product we can do with a lot of different types of income calculations. We can do a full doc, which is just your normal W-2 or self-employed taxes, stuff like that. Anybody that would normally get approved for a loan, we're going to be able to get them approved on this. And then we can also do some of your self-employed borrowers who write everything off like a typical self-employed person and do a bank statement loan, or we can work this directly with investors that buy properties that don't want to use income, and they use a debt service ratio. So essentially, if the payment on the mortgage is $1,000, but the rent for the property is $1,000, we can get the loan done that way.
Hey, Trevor, we've got a question here in the room. Go ahead.
Yeah. So 80% is the highest loan to value you'll do. You won't do higher for higher scores.
No, not on the 10-year interest only. So essentially, as loan products get progressively different, they get a little bit more weird and a little bit better payments or a little bit more lax on income. Those are a more risky product. So the investors require a higher loan to value because of that. They're hedging their risk by getting a higher loan to value. Does that make sense?
Yep.
Okay. So this is just a purchase scenario on the interest only. If you take a $500,000 purchase, you put 20% down on a primary residence, and the person has a 720 credit score. On the 40-year interest only, you are going to get a higher interest rate, and that interest rate is going to be 7.125%. But their principal and interest payment would be $23.75. Now, if you looked at a conventional 30-year fixed interest rate, and this is just randomly 6.375 without any sort of a buy down or anything like that, their payment would be $24.95. So this borrower, if their debt to income ratio was at a threshold where we couldn't get them done with a normal loan, when you add, $100 into their income, you are going to be able to bump up their or lower their debt to income ratio and allow them to get into more house. So that's really the main reason that I think this one works, is to try and get that debt to income ratio lower and try and get them into more house. Does anybody have questions on how this works?
Go ahead.
Yeah, so when you do the loan and it's 40 years loan, so is this correct? What I'm thinking is that it's all built into the loan, so the first 10 years is just the straight, and then it'll automatically have a fixed interest rate at the 10-year mark. It doesn't go with current market rents. I mean, not rents.
No, that's absolutely correct. Your loan is amortized at that interest rate of 7.125 for the full 40 years. They're just giving you the first 10 years as interest only. These products are designed to get a refinance out of these people so that as interest rates go lower, we can actually get their interest rate lower and get them back into the house at a much better, get them a much better loan for the long term. This is really just to get them into the house.
Oh, right, okay. I see.
Yeah. Okay, so that's the 40-year interest only. Now let's look at a 2-1 buy down. From what I've seen in the market, I really do think that the 2-1 buy down is going to be the best product to help realtors sell homes and also get their buyers who have maybe dropped out or they're kind of on the fence, him-hawing about, well, interest rates are this, or, I don't know, the market's going to crash, whatever. I hear a whole bunch of different things coming from buyers all the time. And I really do think this will help any realtor sell a house or get a buyer back into the market. So essentially, sorry, hold on, I've got... Okay. So essentially the 2-1 buy down is a fairly easy to explain loan product. And I honestly don't think even a lot of loan officers understand really how it works until they dig into it. So the 2-1 buy down, it temporarily reduces the person's interest rate, and they technically buy down the interest rate, but I'll get into how it's less of a buy down and it's more of a seller putting money into an account that the borrower does own. So the first year, we'll get into that. So these are the different types. There's a 1-0 buy down, which I really don't think is worthwhile. In this market, the interest rates are still pretty high, and getting a 1% lower interest rate, I don't think will be as appealing to a lot of buyers as what we would want. So then you've got the 2-1 buy down, which is the one that I would personally use this if I were trying to sell a property or I were trying to get a buyer back in. The first year, their interest rate is going to go down by 2%. The second year, it's going to go down by 1%. And then the third year, they're going to get their standard rate that we locked them in at originally on the loan. So if you take a look, the payments drop fairly significantly for what the borrower has to do and what the seller has to do. If you're looking at a $100,000 loan amount on a 2-1 buy down, and again, these are just random numbers, you've got a 5% interest rate, their principal and interest payment would be $537 for that interest rate. Now, what happens is the seller is going to set up an escrow account for the buyer when they sell the property with the lender. And on the first year, if you look at the difference in monthly payment, it's going to be about $115 per month. And what we would have to do is take that $115 times it by 12, and that would give us $1,380. So this buy down isn't really an interest rate buy down. The seller's putting money in an escrow account, and that escrow account keeps the $115 difference in the monthly payment and pays it out monthly to the servicing bank. On the second year, the interest rate would go up 1%. So you'd be looking at a difference in the monthly payment of $60. You times that by 12, you get $720. And then on the third year, it's our actual interest rate of 5%. So you don't have to put any money in the escrow account. The total escrow account, or the total money the seller would have to give to the buyer, would be $2,100. Does that make sense? Is that clear? Is that
So that basically
clear as
is
mud? Probably.
on the escrow account is a prepaid, just to prepay their payment, and it's just taken out every month?
Yeah, correct. That's absolutely correct. That's absolutely correct. So, but this is something the seller has to do. You can only do these on a purchase. The seller is the one that has to set up this buy down. So the really nice thing about this, when they set up this escrow, this money is the buyer's money. So when they do a refinance, which they will do a refinance, that money will actually go into paying down the interest rate or paying for closing costs, and then whatever's left over will come in a principal reduction. So let's say after the first year they decide to refi, their loan amount would probably go down to $99,000. So whatever's left over after they pay for their closing costs would go back to the borrower, which in this case wouldn't be a lot, or would go back into a principal reduction. So it's probably only going to be $500 in this scenario, but that would be $99,000 or $98,500 as opposed to $99,000. Does that make sense?
Trevor, is there a maximum seller contribution on these scenarios?
Yeah, they can only do the exact amount of what the buy down is. So they'll figure out how much the escrow needs to be, and that's what the 2-1 buy down will be. Now, if the seller wanted to do closing costs as well, that's something they could add into. But I would do it as a separate addendum. I would say that, for the 2-1 buy down, this is how much we're putting into the escrow account, and then we're also going to give them an additional, $5,000 for closing costs.
Is that something that actually has to be spelled out on the addendum, what they're using the money for, or is the typical seller closing cost concession wording enough, and then the lender can apply it however they want?
So it is set up that the buyer actually has to sign that they're doing a 2-1 buy down or a 1-0 buy down. So I would personally set it up as a separate addendum.
Gotcha.
Trevor, is there a loan amount limit? So you have 100,000.
Sorry, what was that?
Loan amount limit, because the average home is 500,000. So is there a loan?
Oh yeah, there's no limit. No, there's no limit. We can do jumbo. Well, I think they go up to $3 million. They can do jumbo. They can do regular conventional. It's whatever the loan type is. They can do the 2-1 buy down. It doesn't have any sort of limits on what the loan type is, as opposed to non-QM. They will not do non-QM on this. It does have to be a Fannie Mae or Freddie Mac insured loan.
Trevor, the question in the room here is, can this be on multi-units too, or just single family?
This is a single family product. This really is designed for just a normal person to buy their primary residence. I'm pretty sure you could do a duplex. I would have to ask about a fourplex or something like that. That's a question that I did not think to ask. So that is one that I can find out really easily and get back to you in the next hour.
Okay.
Okay, so if that is clear, then we can move on. This comes down to what we have to do to get one of these one buy downs done. The buy down funds do have to be fully funded at closing. So this is something that will go right on the HUD and will go into an escrow account with the lender. They are not refundable unless the mortgage is paid off. And then that's what I was talking about, where the funds can be applied to that refinance. The funds, and this is why I like a separate addendum, because the funds cannot be used to buy down the interest rate or pay closing costs. So it makes a lot of sense, and it just makes it a cleaner contract if you do a separate addendum for the buy down. And then there is no limit on the total dollar amount for the buy down. So, you know, like I was saying, if there's a jumbo loan or anything like that, that doesn't matter. They just won't allow for closing costs to be added in. So the dollar amount doesn't matter. It's just the purpose of the fund. And then when this loan does get transferred, which it more than likely will to a different servicing bank, those escrowed funds will be transferred to the new servicer. So the loan will act just like it did from the beginning with that lower payment, and that escrow fund will be how they do that. So does that make sense?
Yeah, so I think I understand this right. I got another question. So the buy down is set by what the buy down is. That's the seller contribution. But if we're fortunate enough to get more closing costs or concessions from the seller, we can do both, right? We could apply some to closing costs and then the buy down percentage to the buy down just by separating on an addendum.
Correct. That's absolutely correct. You can get as much money as you want, you know, as much money as the seller is willing to give you, but you do have to separate out the buy down money from the closing cost money. I just really think that a separate addendum is the way to go with this.
Gotcha.
Okay, and I'm really sorry for all the noise, guys. This seemed like a better option than at the house. They were doing a whole bunch of construction, and now I'm at a coffee shop, and they decided to turn on the music loud, so I'm outside, and there's just semis driving by. So. Okay, so now, like I was saying to Jeff, this is a really easy concept if somebody explains it correctly. So the Q&A can be for pretty much anything. I think we've answered a lot of questions on the 40-year interest-only product, and I feel like people understand the 2-1 buy-down product. So I was planning on talking a little bit about some of the things that I've been able to do for other realtors that would be beneficial to you guys. And then, you know, looking for any questions regarding the 2 loan products or any of the questions about what I was about to talk about now. So essentially what I wanted to talk about was a couple of the things that I've been doing to help realtors out. I've been talking to title companies and asking them what deals they have that have been falling out or about to fall out, because I do have a lot of options for loans and a lot of places that I can take loans. I'm also very creative at understanding guidelines and getting more income from a buyer. Actually, Christy knows Matt Barrett, and I helped him with 2 separate loans. One of them had been denied by 2 lenders, and when he brought it to me, I got the loan done in 10 days and saved the deal for him. And that was a $450,000 deal. So that's a significant amount of money. There was another realtor over at Presidio, Barbie, and I actually saved $2 million of production for her. There was one house she was trying to sell for $800,000, and that was predicated on the purchase of the next house for the buyer. And it was a $1.2 million purchase and an $800,000 sell. And she had 3 separate lenders tell her that this was a loan that could not get done. It did take me a while, but I was able to sell that. I was able to save that for Barbie, and that's $60,000 in commission that I got for her. And it's something that I've done for multiple realtors. And so if you guys do have any deals that are falling out, or any deals that a lender has told you no, or maybe their interest rate's gone up too much and so their debt to income ratio has gone too far out of whack, I would love to take a look at those files and see if there's anything that I could do for you guys.
Super
And then if
helpful.
anybody has questions on how I do that, I can definitely answer that stuff as well. Some of it I do like to keep to myself because it's taken a lot of research to figure out some of them. But yeah, if anybody has any questions or anything like that, we can go over pretty much anything that you guys are interested in. If you have any questions about other loan products or anything like that, feel free to bring them up and we can take a look at them.
Can you just give us an example? It sounds like you've got your little own secret, but can you, like, what is it? Are you adjusting income? Are you calculating debt differently? What is it that you're looking at that you can massage to get them qualified where somebody else can't?
So, I mean, honestly, if your buyer has cash, I can utilize that cash in ways that other lenders that I know of haven't figured out yet. Essentially, with Matt's deal, I was able to get almost $700 more in income off of. I'd have to do the math on my head. I don't remember off the top of my head. Hold on one second. Off of about $25,000. So that deal was completely dead and it was going nowhere with anybody else. And I was able to get her $700 more income. And we actually got her into more house than what they were even looking at originally. And then with Barbie's deal, if you're dealing with a person who's looking at a $1.2 million house, they usually have a good amount of money that they can utilize for setting up different ways of getting their income. But this is actually a loan product that it took me a month and a half to find, which is another really nice thing about Luneta. We're able to work very quickly on figuring things out. I found a new lender in the market, and they do a pretty interesting income calculation on their side. As long as the borrower has 15% down and they have 720 credit and they have a year's worth of reserves, we can get that loan done. There's no debt to income ratio. There's no income calculation, nothing. They're essentially looking at that borrower and saying, okay, if this person's buying a jumbo loan and they've got, $200,000 in their bank account, they're obviously somebody who has money. And with the 15% down, they feel like they can hedge their bets on defaults. And that's the way that they're looking at that product. And that's a product I don't know of anybody else that has that product. It took me, like I said, about a month and a half talking to probably 100 different lenders in the market until I found that product. So those are just two examples of how I've manipulated income. The other one that I just got done, the person has 4 mortgage rates in 1 year, and I'm getting that deal done. That's one that I know for a fact. No one that I know of has been able to get that deal done.
Is it legal?
She actually had to do a hard money loan.
What was the circumstance?
Is it legal? I couldn't do it if it wasn't legal. I know.
I know. Tough situation.
4 lates in 1 year. It's an incredibly hard situation. This was so bad. They had already, the lender they were working with, I think they should be fired. They told them that the loan could get done. They actually sold their house, and then the lender told them that they couldn't get it done. So we had to get them a hard money loan. We had to fix a couple of things on their credit. So it's taken almost 2.5 months now to get them to a point where we can get the loan done. But I mean, we're going to drop their payment by $1,000 once they get out of this hard money loan. And again, that's just for me doing the hard work. I do the legwork. I do things that, I shouldn't say all, but a good portion of loan officers aren't willing to put in the legwork that I've done to figure out how to get these loans done. If it's not an easy loan, they're going to tell you it can't get done. Or they're not even going to tell you until you go to close, and all of a sudden you can't close.
It's awesome. You got to get creative sometimes.
Yeah, you really do have to get creative, and understanding guidelines and having a company that's willing to do the things that Luneta has done with me is it's the most important thing that's happened to me with a company that I've worked with. I've never had another company that would find a lender to work with that would do just one loan that we need to get done. We actually, I don't know if any of you guys work with investors who buy multiple properties, but I actually found an investment loan where you have to do multiple properties, but the interest rate's 6.25%. I mean, that's as good as regular conventional financing. That is something I haven't even seen below 7.75 to 8.5 on a loan like that in the market. So yeah, we're out there trying to help people get the best deal that they can. And I think people are seeing it. I have realtors sending me people. I have title companies sending me people. And it does make me feel good to know that the hard work is paying off.
That's awesome. Can you remind me again what states you're able to do loans in?
I would have to look at all of them. We're in about 13 states right now, and just some of the ones I can remember off the top of my head are Texas, Florida, California, Idaho, North Carolina. Those are the ones that I can remember off the top of my head. The plan is to be in 48 states and and Guam. I don't know why, but the owner of our company wants to get licensed in Guam just because he thinks it's neat. We won't be licensed in New York or one other state. They are very, very hard to close loans in, and they typically force the buyer to use an attorney. So it's just a really hard loan to get done, and we don't think it's worth it to get into those markets.
Gotcha.
Yeah. Yeah, and sorry this went a little bit fast. This, like I said, these are just fairly easy concepts once somebody actually explains them to you and gives you the knowledge that you need.
No, these are good options.
I'll start sharing.
We want to have options for our clients, and I'm sure like when you're doing a pre-approval, if they're right on that threshold of purchasing power, this is something that you explain to the clients, right?
Yeah, I do. Another thing I pride myself on is education. It's a big piece of what I do. I explain every number that goes into the file, so when they're looking at their fees, they know exactly what that is. If they can't approve for a normal traditional loan, I explain why that is. I give them as many options as I can find. I explain what the numbers look like. I tell them what my loan would be that I would personally get. But, obviously it's up to them to decide which loan they want to do.
Awesome. Anybody have any questions?
Thank you.
Yep, come on up. Eric's got a question, Trevor.
I'm just curious on when you mentioned creating some income with cash. I assume that would not work with gift funds from family. Is that right?
No, it could totally work with gift funds.
That's interesting.
Yeah, what I'm doing right now, they don't source the funds to set this up, so we can definitely figure out a whole bunch of different options. Well, I shouldn't say a whole bunch of different options. We can figure out a couple of different options to get these people more income. And again, this is something that I don't know of anybody that knows how to do. I've saved multiple loans with setting this up.
So you can create some.
I mean, a lot of loan officers. Yeah, a lot of the loan officers know about asset depletion. That's something that Freddie Mac will allow you to do, but it doesn't give you nearly the amount of income as what I've put together will. And it's just, all it is an interpretation of the guideline. I've only had one underwriter ever question me on it. I sent them the guideline and I said, this isn't up to you to interpret how this is said. This guideline is written out this way, and if Freddie Mac has a problem with it, they can make a new guideline. But for an underwriter to try and tell me that they've decided a guideline directly from Freddie Mac shouldn't be read the way it's written isn't up to them. So I've never had one of these not go through. They fly right through. It's not a problem. And I do all the legwork for the borrower to get this done. They do have to go set up a bank account, but it's really the only thing that they have to do.
Wow, that's crazy. So from your example, if I remember right, $25,000 equated to $700 a month in income that you created.
Yeah.
Yeah, it was approximately. Let me do the math again. Yeah, yep. $700 a month is $25,000. And this is just a traditional loan. So the credit score doesn't have to be high. As long as they'll get approved for a conventional loan, this is totally fine to use.
Yeah, you can get
Nothing special. Not a non-QM loan.
And you're buying the rate down with closing costs from the seller. You really improve that DTI a lot.
So there's no maximum LTV on that. This could be like a 5% down conventional product. Like say if they had more cash rather than put it down towards the purchase price, they could do something like this.
So that's actually a big part of how I make these work is, they're not going to have their 20% down anymore when we use this much cash. So we'll do a 5% down or 3% down conventional and use the cash to set up an account that will allow them to have that income.
I love it.
Yeah, and again, I'm just out here trying to do the stuff that other loan officers aren't willing to do, and it's really helped me a lot. My business is growing fairly rapidly and I really feel like it's because other loan officers, they don't want to work. We're all pretty lazy inherently, and they're not willing to put in the work that I've put in. So a lot of them are dropping out. This isn't a refi boom. You don't get 5 deals a month just because people that have a heartbeat. You're actually out there making calls and doing legwork and trying to get creative to get the loans now.
That sounds a lot like the real estate industry, the realtors.
Exactly. People have to get out there and bang the phones. And, I always tell my guys, I want to see bruises on your ears by the time you leave this office.
Bruises on some aggressive dialogue.
Yeah, I want the phones on your ears until you get bruises. Find a deal today. And that's the other thing. I can put quite a few loans in the pipeline. I've got 5 different loan officers that work with me. The other thing is we do mobile home loans. They are very difficult. We've had some hiccups trying to put together a good process. So that's something I like to tell realtors up front. If you guys are doing mobile homes, I can get those done for you. The process is janky and the investor is a little bit quirky, but as long as you go into it knowing that, it's fairly easy to structure the deal and let the seller know what's happening. But I do have one guy specifically that works on mobile homes, and he also does videos for the realtors, walkthroughs of any listings that we do. They're going to have open houses. He goes through, does a video, and he gets to as many of the open houses we do as possible.
Hey, Trevor,
So again, like I said, I'm just out here trying to help you guys.
is that a chattel lender, or are you talking about loans on mobile homes that have their own land?
Chattel. Yep. Essentially, it's a car loan. It's the most hilarious thing that I've ever done. And, you know, in the beginning, we were really overthinking it. We were using the Fannie Mae and Freddie Mac guidelines, and I called up the underwriter one day and I was like, what are you guys doing to qualify this income? I mean, she literally said to me, well, it's what you wrote down. I was completely shocked. She didn't even check the income. So, I mean, obviously on my side, I have to get the income correct, or if we get audited, they will fine us and I probably close us down. I don't even know. But on their side, the things that they do are very, very quirky. So like I said, it can be a bumpy road, but they are deals that we're getting done, definitely.
I have one other question about that. So they're chattel lenders, but what are their rates usually? Because they're usually like anywhere between.
They're good. Yeah, there's another company, 21st Century, I think it's called, and we're almost always lower in interest rate than those guys. Typically right now they're in the sevens. And then Jeff, there was one thing that I wanted to catch up with you about when we get done. If you have a minute, maybe just call me on my cell phone if you can. Okay. I know you guys are going to go over some other stuff once I get off.
Yeah. This is all good stuff. I think we all took some notes here. Does anybody have any other questions for Trevor? If not, we'll introduce our sponsor. I think Janet just walked in. Anybody on Zoom? Questions? Comments?
It looks like there's one more in the chat, maybe. Oh, with land or without? Yeah, without land. These are chattel loans, like I was saying. This is a real mobile home loan.
Gotcha. Okay, Trevor, I'm going to have Janet come up here, and then I'll call you a little bit later and go over what you need.